Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Hey, not too bad. Hear you were enjoying some good steak with your young son, the new upcoming chef. Hey,
13-year-old wannabe Michelin chef. Yeah, so
that's awesome.
pretty
That's
good.
Congratulations. That's always cool to.
Right.
When young people take an interest in things at a young age, right? It can keep them out of trouble. So they need a passion. They need something to focus on. So that's awesome. Well, we got a lot to talk about in the markets here. First of all, congratulations to all the fans and mostly to the team. Kansas City Chiefs take it this year, second time in 4 years, and it was kind of a interesting battle back and forth there. I thought it would be more boring, but it was actually quite interesting and kind of a nail biter at times there. So anyway, let's talk about where we finished the week here first. So on Friday, we had NVIDIA was down 4.8%, Meta down 2.12%, Google, Amazon slightly down. Kind of the stronger areas were Exxon was up 4.21%, Chevron 2.1%, ConocoPhillips up 4.67%. Utilities were up, healthcare was up. So it was a choppy day, but with a slight slope up. We started at a bit of a discount, but it was quite choppy around the VWAP and the previous day's close. Now the 1 week performance, that kind of tells a tale here. We had Google obviously down in terms of its competition against Microsoft with it's Bard versus ChatGPT. Google was down 9.85% for the week. Amazon 5.59%. Meta down 6.64%. Intel was down 8.31% for the week. AMD down 5.36%.
A lot of market cap.
Yeah, exactly. And Microsoft was up 1.84% for the week. Apple was down 2.26%. Visa, MasterCard slightly down. Only the healthcare plans were up, but not the diagnostics, research, medical devices area. That was all down. So when you think about healthcare, remember to split it into, the key segments there. We have, in healthcare drug manufacturing, for example, we had Merck up 5.47, ABBV up 4.72, Johnny was down minus 1.49. Pfizer down slightly, Lilly up 1.78. And again, for the week, energy came in at 6.48%. Exxon came in at 6.48%, Conoco at 6.43%, EOG at 7.64%, Hess at 6.56%. So Schlumberger even at 7.07%. So quite a performance for the week. Now, this is a little bit of a departure from oil prices for, other than they kicked in when Russia said it was going to cut back production a bit, right? But then the oil prices kind of kicked in. But you can't always lean on oil prices for the performance of the equities themselves. There can be a disconnect there. Equities could perform worse than the oil or better than the oil. So keep that in mind. Tesla was having a pretty good month and into February as well, into the new month here. And it rolled over on Friday. So it still performed at 3.64% for the week, but it was down, I think, 5% or so for Friday. Let me just see here. Yeah, it was down 5% for Friday. So the groups, for that 1 week performance, again, energy came in at 4.85, and then the worst performing was communication services at 6.62% down, consumer cyclical down 3.04. So what kind of happened last week was because we'd been running on this higher expectation of maybe the Fed being a little bit more lenient, inflation maybe tapering off a bit. People were kind of getting their hopes up, and we had been climbing a wall of worry too. But this week, you can see some of those areas like communication services, cyclical, basic materials, real estate, even technology, kind of pulling back for the week a little bit. So keep that in mind. We have on our futures as of right now, we have the Dow Jones futures off slightly at 0.33%, down 113 points. Overall, this has been in a very significant trading range for the last 2 weeks or so. So it's tighter. It hasn't had the kind of movement that we've seen in the S&P 500 or the NASDAQ. S&P 500 is down 0.41% or 16.75 points. NASDAQ 100 is currently down 0.48% or 59.5 points. And that one has really rolled over from that 1300 level. And we've had, a week and a half down now with the NASDAQ 100, whereas the S&P has been a little bit more resilient. It has that resistance up at the 4,200 level. Russell is down only 9 points at 0.47%. It has resistance up at the 20 or the 2000. Where's the high here? 2033. So it's everywhere from around 2000 and 2033 is kind of resistance for the Russell 2000. It's down sharply from that level, and it's sitting kind of on, I would say, previous resistance. So could be new support here temporarily. So there is an air pocket below us in all of these things. Again, the Dow is the most stable sideways, and Russell has pulled back more violently than the Qs, the NASDAQ 100, and then the SPY. So again, we're kind of on the fence, and what concerns me here on the economic calendar is the Valentine's Day CPI numbers.
Yeah.
So this could be a big impact to the market as it has been previously, and just kind of we're on the fence with the market, having rallied then pulled back a little bit, kind of sitting there. It kind of sets us up for we could move either way, and there's room to move either way now. So anyway, we'll roll over to you for more on the economic reports that are coming out this coming week here, and we end the week with Expiration Friday, right?
Yeah. Monday, not too much. There's New York Fed has some inflation expectations, but Tuesday is the big one, the core CPI number that's going to come out at 8:30 Eastern. And then Wednesday, we have retail sales and home builders index. So some light on how the consumer's doing. And Thursday, initial jobless claims, building permits, housing starts. And Friday, index of leading economic indicators. So leading economic indicators, jobless claims, and inflation are the themes for the week there. We have quite a bit of earnings still. There's many, but within the S&P 500, there's like 60 symbols reporting. So still, it's not as heavy as it was previously, but there's still earnings trickling out, so you have to cross-check your symbols when you trade them. And we have two bits of seasonality coming up this week. We have mid-month seasonality and the first Friday of the month. Both are expected to be quite bullish. Mid-month seasonality is the most robust of the month, with the S&P 0.93% for that mid-month seasonality. Small caps at 1.3%. And then the third Friday, it's not as robust. The S&P is kind of flat, while small caps are up. So we have some hope, like midweek, especially if we clear that CPI number, and it's not a Valentine's Day massacre. hopefully not. We should be able to have some strength throughout the middle of the week.
Yeah. Well, I mean, the mid-month seasonality starting there on Monday is supposed to be, the big performer for the month of February, if you're going to get any performance at all.
Yeah.
And so, the opposition to that could be, the CPI on Tuesday and then the PPI on Thursday. Those are the two big influences that could either agree with seasonality and boost it even more, or disagree and throw a monkey wrench into that. So again, it's hard to know. That's why we like to trade hedged, right? That's like why we like relationship-based trading, hedge-based trading, swing portfolios, open to close intraday, stuff like that. But even then, I mean, sometimes when the market moves a lot at 8:30 a.m. Eastern time, that's an hour before the market opens, there can be some significant movement that obviously impacts stocks. But the good news is that you can go and look at where these stocks and where the sector ETFs are trading prior to the market opening. So you can make some informed decisions. What you don't know is whether it's going to be, big down pre-market and then suddenly reverse. We've seen that before. October 13th was a perfect example, or we gap up and reverse, So those are the things you can't know. But typically, if the gap is significant enough, that does tend to favor the long side because the market is a buy side market long term, and gaps tend to get filled, even if they're news related gaps. So just keep that in mind.
Yeah, we have some ETFs within the seasonality window. So mid-month seasonality favors some financials like KRE, KBE,
Right.
jet airline stocks, USO oil, SO the SOX, which is chips, SMH, which is chips, XLF, materials, XLB, and biotech, XBI. So a bit of the risk on ETFs are favored in that seasonality. And then things like XLU are defensive. And that, that's good seasonality.
So we have 61 S&P 500 stocks that have earnings this week. What are some of the major ones that pop out for you on S&P 500?
Yeah, we have Coca-Cola. It's a big one. We have some solar stocks, SEDG, Marriott, Albemarle for lithium, Cisco, MLM, BMC, Zebra. So it's a mix between industrial, some tech, some consumer discretionary as well. But there are a couple key solar ones that are going to pop up in there. So that could move. Copart, Auto Parts, AIG Insurance, Marriott. So yeah, it's a mixture of the economy, not so tech heavy as some weeks.
Just to note that overall the earnings have come in a bit softer than previous years. It seems to be a little bit soft, but I mean the market was shrugging some of that off, and some of these companies that reported poorly did kind of heal the gap, like they gapped down and they ended up finishing okay. So the market's tending to discount that and look forward at things getting better. But it has been a bit softer. And I find there's a difference between the beginning of earnings season and when you get the bigger and more important players kind of reporting first. It starts off with the big banks and brokers and things and it moves on through. But towards the tail end, sometimes they can take these things out and shoot them when they miss earnings. So just keep that in mind. So how it tends to work. So a little bit more forgiveness, I think, to the earlier reporters versus the later reporters. So I understand we have ET is trying to phone home here, and U.S. is and Canada is involved in shooting these things down. I guess we're on our fourth one now. We had, one that was South Carolina, one over Lake Huron, and one over the Yukon, and one in Alaska. So in the last week, we've had 4 of these things shot down. So poor ET. Wonder if he got a chance to phone home before he was shot down. Oh well, it's an interesting world. So what else is going on here?
How about the ETFs, where they are year to date? I mean, it really is a risk on first couple of weeks now, 5 weeks. XLY, XLC, XLK, those are all up 12, 14%. And then all the defensive things like utilities are down 4% on the year, healthcare down 2%, staples down 2%, diamonds up 2%. So all the defensive stuff that was hot at the end of last year is soft. And then the risk on stuff like XLY, XLC, QQQ, that's where all the juice has been the first 5-6 weeks.
We've seen this movie before, though, when you had a really big down year, then the following January, you have that tax loss rebuying. Because taxes have always been a really big, component ever since the Boston Tea Party, right? Taxes are a big deal. And if you can take your tax loss on a bad year like that and then redeploy any capital you have left, or maybe you're well off enough to not be an issue, you still want the tax loss, and then you rebuy it in January. And we also had short covering where they didn't want to cover their shorts into the end of the year. So they carried it over into January and started covering in January. So it's an interesting dynamic of the January effect. We had a little bit of a Santa Claus rally, which ended 2 days into January, obviously. And then we had tax loss rebuying, we had short covering, we had FOMO, we saw a little bit of meme stuff pick up. And the biggest areas of things that came back were, an example would be Tesla. That's a really good example of something that rallied back. And that might be kind of finished now. It all depends on the news this week, I think. We're starting to see some signs that things are mature in terms of pricing and starting to roll over a little bit. So if we get news that contributes to the downside, then it'll pick up speed from here, I would think.
Should be an interesting week.
Yeah. So the treasury yields are all inverted, which is kind of signaling recession. But there's a lot of other indicators that don't really agree with that. And we also have this battle whether the Fed is going to overdo it on tightening and cause a problem, or whether we're going to transition quickly to disinflation or deflation. So, I mean, it's good for the markets when there's a lot of, controversy and nobody's certain. I mean, I tend to think it's a lot better for the markets than everybody being on the same side, of course.
The wall of worry.
Yeah. So, but some would say we've already been in the recession a little bit already. Certainly, we think that real inflation is actually higher than what the numbers suggest, because consumers, have to spend money out there, and so they can see things that have doubled in price or more all the time. So, real inflation might be a lot higher than what the numbers suggest, but that doesn't mean it can't cycle back down very quickly. And I fully expect that at some point. I mean, I think inflation could still get worse from here, or duration of it could be longer, but I think it can cycle back very quickly. It's kind of, to me, a little bit like the markets. When stuff goes up, liquidity is created because people that bought take a profit, new people buy, And so there's actually a liquidity increase. When things drop, you just have a buyer's strike sometimes for a while, and there's no liquidity. And so I look at this inflation thing where, look, the highways are busy, the stores are busy, everybody's trying to do stuff. And it kind of, because it is inflation, you kind of have that hustle, right? You have that hustle. But there comes a point where if people run out of money and cash is closely guarded and people don't want to spend anymore, then you could see the lack of liquidity in a sense, and things could fall very quickly. So I think we could at some point transition to deflation more rapidly than anyone expects. But I think that's still a long way off, but nonetheless. Couple more things here. Let's see. I just want to look at our bonds. So 30-year bond has been trending down, which signals that, we're still expecting the Fed to hike, in small increments going forward. We have metals. Gold is come off of its high pretty aggressively there, silver along with it. Platinum kind of heading down pretty rapidly. Copper's rolled over, so that's a little bit more of a signal of recession, I would think. And then we get into the currencies here. The US dollar did put in a low there right at the beginning of February 2nd to be exact. And not an all-time low, just a low in the last sort of 9 months or so. No, actually, sorry, 11 months. And then it popped up from there, and it's still rising. It's up right now 0.14%, so signaling a little bit more of a rise. That could be looking forward at the CPI numbers. So if the CPI numbers, say that inflation is more aggressive, then that gives the Fed more reason to be aggressive in the hikes. So that's why the dollar might be responding that way ahead of CPI numbers. So tomorrow should be kind of that wait and see game for Tuesday, I would think, because there's no other drivers really tomorrow, is there?
No.
All right. And energy, it's kind of still in its trading range for the last 3 months. Did notch up a little bit, like we said, this week with a rally there, but it's currently down 1.15% here in the Globex. So it could be a bit softer tomorrow. So I'd probably be planning for the dollar to be a little bit stable I would give it a little bit of a long bias tomorrow. I'd give oil a short bias. I'd give gold a short bias for tomorrow. I'd probably, let's see, looking at the S&P again here. I'd probably be leaning to neutral to maybe slightly defensive tomorrow. That's probably how I would lean. Mm-hmm. I don't think there's a reason to be a market to be super aggressive tomorrow because we don't have anything to build on, right? It's more of a wait and see. So that would be my take. Hopefully that helps you guys. Did we miss anything on your? No. Okay. Well, good trading this week, and Friday was expiration as we mentioned, but it's also the long weekend. So you could have a weekend effect there too, right? One aspect is geopolitical concerns globally. Another one is market often likes to rally ahead of a long weekend, gets all excited. So there's a tension there, but and it's also expiration. So fasten your seatbelts for an exciting week, and a lot more exciting than last week because we didn't have much economic news last week, right?
All right. Good luck.
Yeah. Take care.